Today we're going to talk about the number one reason why you should not max fund your 401k IRA accounts and only fund them up to the employer match if you receive one. Now, we've all heard that in the long run, you build more wealth in tax-deferred accounts. Supposedly, you defer income now while you're working and take it out later in the future at a lower tax rate, and you end up with more money in the long run. But I'm going to show you some evidence that that is not always the case. Taxes are the number one reason why you do not want to max fund your 401k or IRA accounts. I'm going to show you 3 different scenarios where max funding your 401k IRA accounts could ultimately end up in you or your family paying more money in taxes in the long run. This first scenario happens to just about everybody. When you pass away and leave your 401k IRA assets to your kids, they will inherit a massive tax liability. It's inescapable. There's no way around it. So look at this example I've prepared here. Let's say that you made contributions to a 401k IRA throughout your lifetime of $1 million. And let's say that you had a $2 million gain in the account, and when you died, it was $3 million. Well, what happens with the taxes? Your kids are going to pay taxes at ordinary income tax rates on $3 million valuation that they inherit. That means, depending on their respective tax brackets, they could be paying as much as $1.1 million in taxes when they inherit your IRA. They have 10 years to withdraw the funds from the IRA, but ultimately they're going to pay ordinary income tax on the entire account value. Let's compare that to saving money and investing it in a standard brokerage account where you're buying indexes, stocks, bonds, etc. Let's say that you contributed $1 million to an investment account. You had $2 million of unrealized gains, and the market value of the account when you died was $3 million. Well, because of stepped-up basis, your kids will inherit the entire account tax-free. That's right. They won't have any taxes owed on the account. When you pass away, they will inherit that account at the new cost basis, which will be the value of the assets on the date of your death. No taxes owed when they inherit that $3 million. It's powerful stuff. So if leaving money to your kids is important to you, clearly max funding your 401k IRA is not the best decision. Consider funding your 401k IRA up to the point of an employer match, but not beyond, and take the difference and invest it in an after-tax account. The money in the after-tax account, investment account, is going to qualify for stepped-up basis when you pass away, and your beneficiaries, your kids, will receive a lot more money and pay a lot less in taxes. Now let's look at a second scenario where max funding a 401k IRA is not the best decision. If you are hyper-focused on putting as much money as you possibly can in 401ks and IRAs, this scenario can easily happen to you. When you get to retirement and you have all of your wealth in tax-deferred accounts, 401ks and IRAs, what do you do when you need a large one-time withdrawal? Let's say that you want to help your kids buy a business, or you want to pay off their student loans, or you want to buy a second home or something like that, and you need a lot of money. Here's an example. Let's say you take $1 million out of your investment account, your IRA 401k, and let's assume that you have $100,000 a year after standard deduction of other income. That would be Social Security, rental income, Airbnb, things like that. So you've got $1.1 million of total taxable income, and that means you're in the 37% tax bracket, the highest tax bracket. And that's what happens when you take a big one-time withdrawal from your tax-deferred account. It pushes you up into a higher tax bracket. Let's compare that to what if you had instead invested money over the years in an after-tax account and you need $1 million. And let's just assume, for illustration's sake, that you take $1 million out of an after-tax account and it's all appreciation, which wouldn't even be the case. but let's just assume it is, and you're going to have a long-term capital gains tax rate, highest one, of 23.8%. Compare 23.8 to 37, it's a big difference. So many people end up in this scenario. They get to retirement and unexpected things happen. They need a large withdrawal. And maybe it's only a couple $100,000. It doesn't have to be $1 million. But the point is that it's very likely you will end up in this situation with a one-time withdrawal where you are paying a higher tax rate on the withdrawal than when you deferred it. So it's reverse arbitrage. It throws cold water on the whole idea of deferring income and paying a lower tax rate later. No, you're paying a higher tax rate. Now, if your current financial advisor is not talking to you about the importance of tax planning when it comes to your retirement plan, please reach out to my office. We would be happy to give you a no-cost second opinion on what you're doing when it comes to your retirement plan. Now let's take a look at the third scenario where building up a very large 401k IRA can work against you in the long run. If you have done a great job of building wealth in a 401k or IRA, RMDs, required minimum distributions, may be your nemesis. In this example, we have a $7 million 401k IRA account value. When you turn 72 years old, your divisor for RMD calculation will be 27.4. Your RMD will be over $250,000. If you have other income after standard deduction of $100,000, you will be in the 24% tax bracket for married filing joint. Now watch what happens as you get older. By the time you're 80, your divisor's now at 20.2, your RMD's over $300,000, you're now in the 32% tax bracket. By the time you're 85, you're at an RMD of over $400,000. You're in the 35% tax bracket. And by the time you're 90, your RMD is approaching $600,000 and you're in the 35% tax bracket. And for simplicity's sake, I've kept the account value locked at $7 million. Reality is the account value will probably grow, at least in the early years here, and your RMD may be even higher. So what does this all mean? It means that the idea, the concept behind tax-deferred investing is upside down. In order for tax-deferred investing to work, for you to accumulate more wealth because you're doing tax-deferred investing, you need to have tax rate arbitrage, meaning that you need to be in a lower tax bracket when you're in retirement versus your working years. But in this situation, if you've built a substantial 401k IRA account value, you may find that you are not in a lower tax bracket during your retirement years. In fact, as you get older, you might end up in a higher tax bracket than when you were working, completely defeating the concept of tax-deferred investing. So let's add it all up. When it comes to leaving money to your kids, IRAs and 401ks are terrible. They are going to inherit a massive tax liability. It's inescapable, and there's nothing you can do about it. The more money they receive, the greater their tax liability if that wealth is in an IRA or 401k. Now, when it comes to large withdrawals in your retirement, to purchase a second home, an Airbnb, help your kids buy their homes, pay off their student loans, buy a business, whatever you want to do. If you need a large one-time withdrawal, $100,000, a couple $100,000, $1 million, you could very easily be in a situation where your tax bracket now is higher than while you were working and deferring that income. It's backwards. It defeats the whole purpose of IRAs and 401ks. Oh, I'm going to defer income while I'm working and then take it out slowly while I'm retired, supposedly at a lower tax bracket. But I've seen plenty of situations where people end up in a higher tax bracket with an IRA in retirement, and that's one of them. The final scenario is that if you really knock it out of the park, if you're a go-getter and you build a lot of wealth, specifically in IRAs and 401ks, it can definitely work against you. You may not be in a lower tax bracket during retirement, especially when required minimum distributions kick in. You might be in the same tax bracket, possibly a higher tax bracket. Is it worth it? I hope this video was helpful. I hope it gets you thinking about your investments and overall improve your family's financial plan.